Greetings, members, one and all of the Salivation Nation, protecting you from the world's debt. Let's explore. There is a theme here of more and more debt, modern monetary theory, quantitative easing, easy money policies. It's happening worldwide. Obviously, certain nations have a greater debt to GDP ratio than others. We're going to talk about those issues and how it affects you and how you can be protected from this. Because nonetheless, this is something that's becoming a growing concern. So let's look here at the state of the world's debt in this infographic from visualcapitalist.com. You see the government debt by country. First, let's talk about what the GDP is and how it relates to debt, the gross domestic product. It's a simple metric that compares a country's public debt to its economic output. The higher a country's debt to GDP ratio is, the higher the risk for that country's defaulting on its debt, therefore creating a financial panic in the markets. And they are pushing it all around the world. And they have a solution, but their solution is not your solution. So if we look at the debt to GDP ratio in 2021, according to the IMF or the World Bank here, published a study showing that countries with a debt to GDP ratio of 77% or more during prolonged periods of time can cause economic slowdowns. And so this is a pretty well done graphic here that shows all of these different measures. And so the areas in light blue or gray are greater than 50%, and then light orange greater than 77%. A deeper orange yet is greater than 100%, and a light red to a deep orange are greater than 200%, and a red hot is over 250%. So we can look here that it kind of glows counterclockwise in terms of the debt to GDP ratio, with Panama being the lowest at 62%, and with Japan being the highest as you go around the dial here to 257%. Japan has been at it for quite a while, in fact, since 2010. But we look there, we can see with Panama being 62%, let's take a look at our country here, the United States, and what the past debt to GDP ratios have been according to our measures from the our federal debt to GDP ratio. In 1960, it was 52.6297%. In 1980, it was down to 34.56%. In 2000, it was 58.21%. And now it's at 125.56%, according to debtclock.org. But then if we look over here and look at the tax revenue and the personal debt and everything like that, the total debt to GDP ratio is almost 140%, 139.07% when you take into account local debt, state debt, and the like, and the debt per citizen. So the total debt to GDP ratio is 139.03%, which it hasn't been that high since World War II here in the United States. World War II was certainly a different time, and was obviously a lot of money was spent for the war effort and the like, so that's what contributed to that. We don't have that now, but we have a war against pretty much everything else, including the pandemic. But there's other money being spent on climate change and all these other things that people liken to a, quote, war. And we're also supporting, Ukraine's fight against Russia. But those are really still, it's a lot of money we're sending, but nonetheless, there is that. So Sudan is the next highest with 210%, very small economy, small country, but nonetheless, it's still pretty alarming there. Greece, no surprise there. We've seen that for quite a while. Greece and Japan really are no surprise. The U.S. here, according to this, is 133%. So pretty much like an average between 125 and 139, and that's probably where they get that number, 133 or thereabouts. Pretty interesting to see all these other countries, how China's is about 69%. Very interesting indeed to see theirs is much lower. South Sudan is 64%. And we can kind of look around here and see what other nations are. Russia should be pretty low, at least before this war. I'm trying to find out where they're at. Doesn't look like they're in the trying to see where their listing is here. They very well may not be on this list, which means they may be under 62%. Quite possible, because I think one thing that they pride themselves on is not getting into debt. So they may not have even made this list. I don't see them there. More likely with all the spending on the war and on the sanctions and stuff like that, those numbers will change soon anyway. Nonetheless, there that is. So Japan has the highest debt to GDP ratio of 257%. In 2010, the country became the first advanced economy to reach this 200% level, and that was in 2010. So they've been surviving, obviously, for that long. They must not think it's that big of a deal. Countries such as Venezuela, Afghanistan, and Argentina did not have data available for 2021. All other countries missing are typically not reported on by the IMF, such as North Korea. No surprise there, but Russia is my guess that they would have, but maybe not. So COVID-19 started the spread around the world in 2020. The global economy has been put to rest with supply chain disruptions, price volatility for commodities, challenges in the job market, and declining income from tourism. The World Bank has estimated that almost 97 million people have been pushed into extreme poverty as a result of the pandemic. In order to help with this difficult situation, global governments have had to increase their expenditures to deal with higher healthcare costs, unemployment, food insecurity, and to help businesses to survive. Countries have taken on new debt to provide financial support for those measures, which has resulted in the highest global debt levels in a half century. And so that's where these charts come from. And we know that which is, of course, obviously, this is just kicking the can down the road. This does not solve the problem, obviously. But there are solutions to this, and it's about saving. And it's not just about saving cash either. You probably already know. We'll get to that in a moment here, but for those maybe who are not aware of this, this is something that should be considered here. And by the end of 2020, the Bank of Japan owned 45% of the government's debt outstanding. So what happened is to finance this new debt, the Japanese government issued bonds, which get bought up primarily by the Bank of Japan. And so that's where you get the bond yields and the like. And of course, our Federal Reserve is involved in those here. A rapid increase in government debt is a major cause for concern. Generally, the higher a country's debt to GDP ratio is, the higher chance the country could default on its debt, therefore creating a financial panic in the markets. Now, is that likely to happen? No. We did see Standard & Poor's, I think, gave us a rating down to, I think, A or something like that, as opposed to A+ at a particular time. That really did not have much effect, but the World Bank published a study showing the countries that maintain a debt to GDP ratio of over 77% for prolonged periods of time experience economic slowdowns. Well, is 12 years considered a prolonged period of time? I don't know. How is Japan's economy? And we know that this report from the IMF, it shows at least 100 countries will have to reduce expenditures on health, education, and social protection. Austerity measures to some degree. Greece had to go through that. 30 countries in the developing world have high levels of debt distress, meaning they're experiencing great difficulties in servicing their debt. The crisis is hitting poor middle-income countries harder than rich countries, Wealthier countries are borrowing to launch fiscal stimulus packages, while low and middle income countries cannot afford such measures, potentially resulting in wider global inequality. And interest rates are a warning from the IMF. The global debt reached $226 trillion by the end of 2020, seeing the biggest one-year increase since World War II. Borrowing by governments accounted for slightly over half the $28 trillion increase, bringing global public debt ratio to a record of 99% for the global public debt ratio of GDP. As interest rates rise, IMF officials warn that higher interest rates will diminish the impact of fiscal spending and cause debt sustainability concerns to intensify. The risk will be magnified if global interest rates rise faster than expected and growth falters, the officials wrote. A significant tightening of financial conditions would heighten the pressure on the most highly indebted governments, households, and firms. And we are the households. The public and private sectors are forced to deleverage simultaneously. Growth prospects will suffer. Now, what do you do when you have a global debt ratio at 99% of GDP? Who's going to bail you out? Well, maybe this is why, in spite of the warnings of Stephen Hawking, that officials have tried to send out signals to potential extraterrestrial life forms of where we are at in the universe and in the solar system. So maybe we can get bailed out by some alien entity. Who knows? Really, the better measure to protect your wealth is to two things. It is to get your own personal debt under control, pay off those high interest credit cards first and foremost, get yourself as much out of debt as possible. Obviously, there are what is known as good debt. In other words, fixed income or fixed interest rate debts like mortgages is considered good debt because you need a place to live and you're earning equity every time you pay your mortgage. And so that is a good debt to have because you know that payment is not going to change no matter what inflation does if you have a fixed interest rate, preferably one before they started raising rates, and preferably getting a mortgage before the housing market started to kind of explode in price. I mean, we're seeing it rise up even more so now. Sooner or later, that's going to come crashing down. I don't want to be there for that in the housing market. But nonetheless, that is brutal. That's a risky situation. Real estate, I believe, is risky right now, considering where the prices are. Pretty crazy. So get yourself as much out of the bad debt as possible with high interest loans, credit card debt, and that kind of thing. Next thing is to protect yourself with precious metals. That's right. Gold especially has proven itself time and time again to be a wealth preservation tool, a savings. Not only is it good to save in precious metals, it's also good to have some cash on hand in spite of high inflation, running it hot at 8.5+% year over year. That's by the official measure of the Consumer Price Index. We all know it's greater than that by most measures. But holding precious metals, gold, and yes, even some silver too, is a good way to do it. And when I say hold, I'm not talking about buying and hoping to flip for a profit. I'm talking about holding for the long term. And I'm not just talking about 1 year either. I'm talking multiple years. It's a buy it and forget it type of strategy. You buy it and you hang on to it for the long term. And buy smart. Buy silver and gold with the lowest premiums possible, with the most recognizable and liquid forms possible. Silver and gold, precious metals, are definitely the way to be able to preserve your wealth and save you and protect you from the world's debt. No matter what the world does, gold, especially gold, but silver too, have maintained a constant throughout history, have survived epochs, generations, cultures, political systems, empires. For thousands of years, gold and silver have proven themselves, and they will continue to do so no matter what happens, no matter what kind of digital assets out there, NFTs or other investment vehicles, or whatever happens to them, crashing or not crashing. Gold and silver provided a store of wealth. So there you have it. There's the way to protect yourself from the world's debt. I hope you found this video insightful. Would like to extend a multitude of gratitude to you all for taking the time to watch and encourage you to please rate, share, comment, and subscribe.